We started with finance theory of how banks work and the role that capital plays in them, and you identify what are the issues that are trying to be solved, and then you look at the proposal that this Basel group has come up with, and you start to sort of connect the dots and try to make an evaluation whether the solution is sort of, proposed solution is solving the problem or not. And in fact, to some degree, we found it wasn't. There are, in effect, at least 3 different players in this whole process. There are the policymakers in Basel, as well as all of the folks that run the central banks. We were dealing with the Riksbank, the Central Bank of Sweden, but we have the Federal Reserve in the US, and every country has one. So that's the policymakers. Then you have the academics, that's us, and then you have the bankers. And the bankers, of course, try to influence the political process, and so the bankers are very happy with this outcome. We, the academics, had much more concern with it because, in some sense, it didn't solve the problem. And the problem was that we had just had a major banking crisis where the focus was systemic risk, where the whole system failed. And as a result, the central banks and the financial system managers had to bail out a bunch of banks. And that was supposed to be what Basel III solved. It doesn't seem to have done that. It's not going to have any negative effects, but it's not going to have any positive effects.
There were 2 specific questions we were asked about. So one was the borrowing rates. I mean, that's sort of really important. That's the major role banks have, is they lend money, and if there are big effects of, it leads to higher borrowing rates, these new regulations, that's something you could argue that, in a sense, the economy is not working as well. So sort of, it's very difficult to come up with real numbers there, but we did the best we could and basically looked at existing literature and made our own estimates and came up with an answer that there will be very marginal impacts in our view, that we're talking about much less than 1 percentage points. One of the changes proposed is that the banks are going to have higher so-called capital ratios, which is measures how much equity the bank has compared with how much debt it has. And typically one says that a higher capital ratio leads to lower risk, but it might also lead to higher borrowing rates for customers because of things like tax shields. Now, when we did the numbers, it just came out that the effects would be very small.
The GDP growth follows directly from the interest rate effect. If you're not having much of an important effect on raising interest rates because of the higher capital requirements, then you're not going to have much of an effect on GDP. And we confirm that. One view would be they should have raised the capital requirements simply much more than they did. They were reluctant to do it because the banks were petitioning, saying if you do it too much, we're going to have these terrible effects. We don't necessarily believe the effects would have been anywhere near that terrible, and you would have gotten more benefits. More complex would be to deal in various ways directly with the systemic risk problem. And that requires a different kind of regulation, would be the second path. In fact, Johan and I have actually written a paper that deals with it in various respects in terms of you might want to segment the riskiest parts of the banking business into a special section where it would not have this contagion to the whole financial system. This has sometimes been called the Volcker rule. And it is, by the way, embedded in a sense into Dodd-Frank, although it remains to be seen how it gets implemented. But it did not make it into Basel III so far.
The whole reason we have these new regulations is to address the issue of systemic risk. And I think a lot of people in academia feel that this is not going far enough. There are lots of so-called macroprudential tools that have been suggested, and Dwight just mentioned one of them, of this type of segmentation. Other people have suggested that we need a much tighter regulation of the so-called shadow banking system, which are a lot of institutions that can basically act as banks, but they don't have the strong regulation that actual banks have. And a third a third suggestion has been that you should introduce some new type of assets. You shouldn't just have equity and debt. You should have assets that basically turn into equity in bad times. For Sweden specifically, we identified two sources of systemic risk that we think are still there even after the new regulations. One is, of course, that Sweden is a small open economy, meaning that anything that happens globally will affect Sweden pretty drastically. The other thing is that in Sweden there's been a real estate boom over the last 15-20 years or so. Prices have increased a lot, and some people feel that there's a real estate bubble, and the vast majority of mortgages are handled through the banking system in Sweden. So with a real estate crash like the one we've seen here in the US, that could have severe systemic effects on the Swedish banking system.
There's an important link from the Basel III and its implications for the Swedish mortgage market to the United States. And for one thing, I would say, Johan doesn't have to say it, but I can say the Swedish mortgage market has actually performed incredibly well over the last 15 or even 20 years. And I think when one starts to think about how the US mortgage market should be reformed, Sweden, along with some other Western European countries, provide very useful models. And one sort of really important point is they have nothing that looks like Fannie Mae or Freddie Mac. The Basel III does put in some additional requirements concerning mortgages and how they would be treated by banks, and I think that's all to the good. And I'm hoping as the U.S. reforms our mortgage market, we will as well take that into account. So you need to both remove Fannie and Freddie. They were just a terribly negative influence on the markets, but then you have to build up your regulatory structure, anticipate more of these mortgages are going through the banks. Voila, you need a Basel III requirements with very good regulators overseeing it.